Hello everyone, thank you for coming to my channel. Today I would like to read an economic letter from FRBSF. It is a research from the Federal Reserve Bank of San Francisco. The title of this review is A Review of the Fed's Unconventional Monetary Policy. It is written by Glenn D. Rudebusch. The Federal Reserve has typically used a short-term interest rate as a policy tool for achieving its macroeconomic goals. However, with short-term rates constrained near zero for much of the past decade, the Fed was impelled to use two unconventional monetary policy tools, forward guidance and quantitative easing. These tools likely strengthened the economic recovery and helped return inflation to the Fed's target, although their full impact remains uncertain. In recent years, the term conventional monetary policy has referred to a central bank altering a short-term interest rate to achieve its macroeconomic objectives. Specifically, in the United States, the Federal Reserve conducts conventional monetary policy by setting the federal funds rate to reach its legislated goals of full employment and low inflation. However, during the global financial crisis and the Great Recession of 2007 to 2009, central banks around the world pushed short-term interest rates to near zero, effectively their lower limit. Unfortunately, given the severity of the economic downturn, even these ultra-low interest rates were not enough to revive output and employment growth sufficiently. Therefore, central banks turned to additional policy tools to achieve their objectives. For the Federal Reserve, these unconventional monetary policy tools included forward guidance through communication about future short-term interest rates, as well as the purchases of government bonds or quantitative easing. This economic letters briefly describes why these unconventional policy tools were adopted, what effect they likely produced, and what their future may be. The introduction of unconventional policy. To provide some perspective on why the Fed adopted unconventional monetary policy, Figure 1 shows that the Fed reduces its policy interest rate, the federal funds rate, about 6 percentage points for 1990s and 2001 recessions in order to boost spending and growth. These conventional policy responses are broadly consistent with what a simple rule for setting monetary policy would have recommended given the level of unemployment and inflation. This specific policy rule recommends lowering the funds rate 1.5 percentage point if core inflation falls 1 percentage point, and lowering is 2 percentage points if the unemployment rises 1 percentage point. The rule also accounts for a downtrend in the steady-state inflation-adjusted short rate, known as R-star. During the global financial crisis and the Great Depression, the Fed again cut the funds rate a bit more than 5 percentage points. However, given the much worse economic conditions, the usual response wasn't nearly enough. With the unemployment rate reaching 10% in 2009, the simple policy rule would have prescribed much more monetary policy stimulus. Indeed, an additional 7 percentage points of interest rate cuts. The resulting large conventional monetary policy shortfall is evident in Figure 1. Unfortunately, the Fed was limited from lowering the funds rate further because of an effective lower bounce on interest rate near zero. The shortfall between what the Fed could deliver with conventional policy and what seemed appropriate given the dire economic conditions promoted the Fed to employ unconventional monetary policy tools. When conventional policy employs a short-term interest rate to affect financial conditions and the economy, unconventional monetary policies uses other tools to do so. The Fed employed forward guidance and quantitative easing as these unconventional policy tools. Please refer to Color 2018. The Fed's forward guidance. After reducing short-term interest rates to near zero, the Fed sought to affect longer-term bond yields and other financial asset prices directly by providing forward guidance about future short-term interest rates. To understand this process, note that longer-term yields has two key components. The first, the expectations component, is the average of expected future short-term interest rates over the maturity of the longer-term bond. The expectations component of, say, the 10-year bond yield is the average of expected short rates over the next 10 years. The second component is a term premium, which includes compensation to investors for the risk of holding long-term bonds. The expectations components can change when the Fed provides information about the future path of short rates. In the aftermath of the Great Recession, the Fed's forward guidance was meant to push down expectations of future short rates, lower longer-term yields, and ease financial conditions. In addition, if forward guidance results in a tighter distribution of short rate expectation around a future path, it can also reduce interest rate volatility and uncertainty, which can lower risk and term premium and further contribute to easier financial conditions. To illustrate some of these effects, Figure 2 shows the actual funds rate and financial investors' mid-year expectations for the path of the future funds rate. Early in the recovery during 2010 and 2011, market investors anticipated a quick policy rate liftoff. The upward sloping dashed line starting in those years indicates near-term expected increases in the fund rate. However, given the depth of the recession and associated measures of the conventional policy shortfall, the Fed did not view such an early liftoff as appropriate. To convey this assessment to investors, the Fed provides explicit forward guidance about the path of the future funds rates. For example, on January 25, 2012, the Federal Open Market Committee (FOMC) stated that economic conditions are likely to warrant exceptionally low levels for the federal funds rate at least through late 2014. In that same month, the FOMC released participants' numerical projections of the federal funds rate, the so-called dot plot, which showed that many of them expected liftoff to be years away. The gray line marks the dates of these two releases of forward guidance that indicated that the federal funds rate was expected to remain at essentially zero for the next 2 years. Such forward guidance helps push down market expectations, flattering the dashed lines in 2012, 2013, and 2014, reducing longer-term yields and easing overall financial conditions. During the past decade, forward guidance has generally been viewed as an effective policy tool to support the economic recovery. This is consistent with past episodes when the Fed also employed forward guidance, although in a much more circumspect fashion. Still, forward guidance is not costless. Please refer to Rudebusch and Williams 2008. And while it can be an appropriate policy tool, the extent of its future use by the Fed is open to debate. The Fed's quantitative easing. The Fed's second unconventional monetary policy tool was quantitative easing, or QE, which involved Fed purchases of longer-term bonds. The gray line in Figure 3 plots the evolution of the Fed's Treasury and agency bond holdings as a simple summary of its QE program. At the start of the crisis, these holdings were was less than $1 trillion. Then, with three separate waves of purchases, QE1, QE2, and QE3, the Fed's balance sheet increased to over $4 trillion. These purchases are often thought to work through a straightforward demand-supply channel. Greater Fed demand for bonds tends to push up bond prices, which pushes down yields. This portfolio balance channel requires some imperfect substitutability among financial assets and operates by reducing the term premium on longer-term yields. Bond purchases also may provide a signal about how the policy rate will be adjusted in the future, a form of forward guidance, and in this way, QE can also reduce the expectations component of yields. Bohr and Rudebusch 2014. The balance sheet depicted in Figure 3 is a crude measure of QE for several reasons. Gannell and Sachs 2018. First, the effects of QE purchases are likely to depend on the stock of bond holdings relative to the size of the economy or relative to the aggregate size or riskiness of the bond market. As the economy grows larger, a fixed 100 billion US dollar purchases of securities will generally cause a smaller ripple in the bond market and a smaller effect on term premium. Second, a more precise measure of QE would take into account the maturity of the asset purchased. For example, purchases of short-term securities will be likely to have a smaller effect on 10-year yields than purchases of long-term securities. Finally, the effects of QE are also likely to depend on the expected time portfolio of the Fed's holdings. A QE program is intrinsically a policy of forward guidance, not about the short-term policy rate, but about the expected time profile of the stock of Fed asset holdings. Much evidence regarding the effects of QE comes from event studies that examine how asset prices shift in the hours after a Fed QE announcement. Christensen and Rudebusch 2012. For example, on March 18, 2009, the Fed announced that it would be purchasing an additional 300 billion US dollar of Treasury bonds. Although short-term interest rates were stuck near zero, longer-term rates fell immediately, with a 10-year Treasury yield declining about one-half percentage point. Of course, such immediate responses are not in a good measure of the effects of QE if they are reversed in a few days or weeks, and the possibility of such reversals is one reason why the economic impact of QE is still debated. On the one hand, Greenlaw et al. 2018 argue that QE has a very small and erratic effect on financial conditions and the economy. By contrast, Gagnon and Sachs 2018 drawing on a variety of research studies that examine the consequences of the Fed's QE purchases, argue that the Fed's total QE program was roughly equivalent to a cut in the federal funds rate of several percentage points. As economic conditions turned more favorable, the Fed started to reduce the size of its balance sheet in 2018 by limiting the replacement of maturity securities in its portfolio. The dashed line in Figure 3 showed a possible future scenario for this policy normalization given in an April 2018 report on open market operations from the New York Fed. The Fed's balance sheet is not projected to return to a pre-crisis level from two reasons. First, the economy was growing, and there is now about twice as much U.S. currency in circulation than at the start of the financial crisis, which commensuratedly boost the size of the Fed's balance sheet. Future currency growth is also projected to continue, assuming that dollar remains desirable for the payments as a store of value. Second, along with more currency, this scenario projects sustainability more reserves in the financial system. In part, this reserves reflects greater precautionary demand for liquidity by many private financial institutions since the crisis. This reserve cushion also represents a possible shift away from a pre-crisis monetary policy regime of operating with scarce reserves to one with abundant reserves. Conclusion: unconventional policy was born of necessity given the financial crisis, deep recession, and near-zero short-term interest rates. Such extraordinary circumstances may not be often repeated, in which case the unconventional monetary policy toolbox may sit on the shelf for some time. However, interest rates have trended lower in recent decades, reflecting low inflation and persistently low inflation-adjusted interest rates in the wake of an aging population and low productivity growth. If this situation continues, the lower bound on interest rates is likely to constrain short-term interest rates again and pave the way for further use of unconventional policy. The author of this paper, Glenn D. Rudebusch, is Senior Policy Advisor and Executive Vice President in the Economic Research Department of the Federal Reserve Bank of San Francisco. And that's all for today's reading, and thank you for your listening.